But the question is, where do they get the money? But before we answer that question, let's just take a look at this. So you can see the growth of the private credit markets. This is going back to about 2000 when they were barely not even existent. But as you can see, even though banks keep getting bigger and the margin requirements keep getting dropped on banks so they can make more loans than ever before, the extent that this private credit is being used is going almost parabolic. Here we have, this is through about 2023. 2025, it's even higher. But you can see the rapid rate of growth. And of course, the red here is all in America here. So you can see it's being used in other countries, but it's mostly being done in America. So it's becoming really popular. But again, you've probably never heard of it. But let's take a look at this. Where does the money come from? Because this is the big piece that's going to maybe irritate you a little bit. Let's break this down. So as you can see here, this sort of breaks down how the private credit system works. So what we have up here, private credit in investors and borrowers. So right here, this is the long-term investment horizon. This is the money that comes in. And right here, it says pension funds. So maybe some of your money going in there. We have insurance corporations. So if you have money in some sort of insurance policy, it's right there, sovereign wealth funds, and of course retail. So all that money goes into these funds that we're going to talk about here. And eventually it comes down to these corporations that need to borrow money that are maybe too risky, that can't get it from the banks. But it's coming from your pension funds. It's coming from your retirement account specifically. Now, the problem that makes this so dangerous is, as I said, it's like the shadow banking system, meaning it's not being watched, it's not being exposed, and it's not being regulated the rest of the system, the way the rest of the system is. And the problem is that we have a massive conflict of interest. Now, I said conflict, or is it a model? Have they developed a model that's a conflict of interest, but it's the way the model works? And they need the conflict of interest in order for the model to work. So let's take a look at how all of this works. Now, first of all, one of the big firms that we're going to use as our example here is Cliffwater. So what we can see is that Cliffwater Corporate Lending has been given an A as their issuer credit rating. So on paper, it looks great. Oh, A plus, A, okay, that's fine. Looks really good. At approximately $40 billion in assets, Cliffwater Corporate Lending is one of the largest U.S.-based perpetual life funds, perpetual life. So they loan money through that. And A means they have a long-term issuer credit rating. Okay, so they're really good. But how do they get that A credit rating? Well, it's pretty interesting the way that works. Let's take a look at this. So we can see here, it says a Bloomberg TV segment on private markets warns. So even TV is warning people. Most people just haven't picked this up. They're warning that private equity, they have a very strong incentive. They have strong incentives. Charlie Munger would say, show me the incentives, I'll show you the outcome. Look at the incentives here. To cherry pick prices that let them reap